Why do schools teach you complicated math formulas but never teach you how money really works? Why do they make you memorize historical dates but never explain how to build wealth? That's not an accident. The system isn't designed to make you rich. It's designed to keep you working, spending, and staying in debt. Banks don't want you to be financially free because the more confused you are about money, the more they profit from you. Think about it. Why does your bank encourage you to save money but barely give you any interest? Why do credit cards seem so easy to get but so hard to pay off? Why do banks charge hidden fees that most people never even notice? Because the less you know, the more they win. But today, that changes. In this video, we're exposing 7 shocking truths about money that banks never want you to know. And by the end, you'll see money in a completely different way, one that puts you in control, not the banks. Number 1, banks make more money when you stay in debt. Most people assume that banks are their financial allies, encouraging them to save and grow their money. But in reality, banks don't profit much when you save. They profit when you borrow. Every loan, credit card, mortgage, and financing option they offer is designed to keep you in debt for as long as possible. The longer you owe them money, the more interest they collect, turning your debt into their steady stream of income. Take credit cards, for example. Millions of people swipe their cards daily, thinking they'll pay off the balance later. But banks know that most customers won't. In fact, credit card companies make billions from people who only pay the minimum due each month. With interest rates as high as 20% to 30%, a simple $1,000 credit card purchase can turn into $2,000 or more in repayments if stretched over time. This is why banks encourage people to carry balances instead of paying in full, because every month you remain in debt, they earn more money. Mortgages work the same way. While owning a home sounds like an investment, a 30-year mortgage at just 5% interest can end up costing nearly double the home's original price. For example, if you take out a $300,000 mortgage, you could pay around $580,000 by the time it's fully repaid. That's nearly $280,000 in pure interest money that goes straight into the bank's pocket. And if you refinance thinking you're getting a better deal, you might actually be extending the loan term, giving the bank even more time to charge you interest. Student loans and car loans are no different. Many people think refinancing their loans or extending their payment plans makes things easier, but banks promote these options because they increase the total interest you pay over time. For example, extending a 5-year car loan to 7 years lowers your monthly payment, but it also means you pay thousands more in interest. The same applies to student loans. Many people stay in debt for decades, paying interest long after they've left school. The harsh truth is that banks don't want you to be debt-free. If everyone paid off their loans quickly, banks would lose billions in interest. That's why they create strategies to keep you in debt by offering low minimum payments, refinancing deals, and attractive loan terms that seem helpful but actually benefit them. The sooner you focus on getting out of debt instead of just managing it, the more control you'll have over your financial future. Number 2, your savings account is losing you money. Most people believe that saving money in a bank is the safest way to secure their financial future. Banks actively promote savings accounts, making it seem like a responsible and risk-free way to grow your wealth. But here's the truth. They don't tell you your money isn't really growing. In fact, it's losing value every single year due to inflation. What feels like a safe financial move is actually a slow drain on your purchasing power. Let's break it down. The average bank savings account offers an interest rate of less than 1% per year, with some as low as 0.01%. Meanwhile, inflation averages between 2% and 3% annually. This means that while your savings account might technically be increasing in balance, the real value of your money is shrinking. For example, if you have $10,000 in a savings account earning 0.5% interest, you'll have $10,050 after a year. But if inflation is at 3%, the same $10,000 will only have the buying power of $9,700. So even though your balance goes up slightly, your ability to buy things decreases. Banks don't warn you about this problem because they profit from holding your money. When you deposit cash into a savings account, the bank doesn't just let it sit there. They take your money and lend it out to other people at much higher interest rates, such as 5%, 10%, or even 20% for credit cards. The difference between the tiny interest they pay you and the huge interest they collect from borrowers is called the net interest margin, and it's a multi-billion-dollar business. Essentially, your money is making them rich. Not you. Of course, having some savings for emergencies is important. Financial experts recommend keeping 3 to 6 months worth of expenses in a savings account for unexpected situations. But relying solely on a savings account to build wealth is a mistake. If your goal is to grow your money, you need to put it in places that outpace inflation. Smart investors put their money into stocks, real estate, index funds, and other appreciating assets where returns average 7% to 10% per year, far surpassing inflation. The bottom line is simple. Banks want you to keep your money in savings accounts because it benefits them, not you. If you want your wealth to grow, you need to move beyond the traditional idea of saving and start thinking about investing wisely. Learning how money works is the first step toward financial independence because the banks certainly won't teach you. Number 3, hidden fees are draining your bank account. Banks love to charge fees, and most people don't even realize how much they're paying every year. These fees might seem small, but they add up quickly, and banks make billions off them. Think about how many fees the average person faces. Monthly maintenance fees just for having a checking account, ATM withdrawal fees when using another bank's machine, overdraft fees when your balance drops below zero, foreign transaction fees when traveling abroad, wire transfer fees just to move your own money. In 2022, banks made over $8 billion from overdraft fees in the U.S. alone. That means millions of people were charged $35 or more just for spending a little over their balance. The worst part? Many of these fees are avoidable by choosing a bank with fewer fees, setting up alerts for low balances, and using in-network ATMs. You can keep more of your money. Number 4, banks keep you loyal while offering new customers better deals. If you've been with the same bank for years, you might assume that your loyalty is rewarded, but the reality is the opposite. Long-term customers often get worse deals than new ones. Banks use a tactic known as the loyalty tax, where they slowly reduce benefits for existing customers while offering attractive promotions to bring in new ones. They count on the fact that most people won't bother switching banks, even if they're getting a bad deal. For example, let's say a bank is trying to attract new customers. They might offer a 3% interest rate on a savings account or a credit card with no annual fee for the first year. But if you've had an account with them for a while, you may only be earning 0.5% interest on your savings, and your credit card might come with higher fees over time. The same happens with mortgages and loans. Banks give better interest rates to new borrowers while charging higher renewal rates for loyal customers who don't compare offers. This strategy works because most people assume switching banks is too much hassle. Banks take advantage of this mindset, knowing that their long-term customers are unlikely to leave, even if they're getting a worse deal. That's why they keep introducing new bonuses, cashback offers, and higher interest rates, but only for fresh signups. Meanwhile, their existing customers silently lose money due to lower returns and increased fees. The key takeaway: loyalty doesn't pay in banking. If you want the best financial benefits, you have to shop around, compare interest rates, fees, and perks across different banks, and don't be afraid to switch if you find a better deal. Banks make money when you stay passive, but you can outsmart them by being proactive with your finances. Number 5, your deposits aren't sitting in the bank. Most people believe that when they deposit money into their bank account, it simply sits there safely stored until they need it. But that's far from the truth. Banks don't keep most of your money in their vaults. Instead, they use a system called fractional reserve banking, which allows them to keep only a small portion of your deposit and lend out the rest to other customers. In many cases, banks hold as little as 10% of deposits in reserve, meaning that for every $1,000 you deposit, only about $100 is actually kept available, while the remaining $900 is loaned out or invested. This system is how banks make money, but it also comes with serious risks. Since most of your deposited money is being used elsewhere, banks rely on the assumption that not everyone will withdraw their funds at the same time. But if too many people try to withdraw their money at once, like during an economic crisis, it can trigger a bank run. This happens when customers panic and rush to take out their savings, only to find out the bank doesn't actually have enough cash to give everyone their money immediately. This is exactly what led to the collapse of several financial institutions in history, including the Great Depression-era bank failures and the 2008 financial crisis. Governments tried to prevent total financial collapse by offering deposit insurance, such as the FDIC in the U.S., which insures up to $250,000 per depositor per bank. However, this doesn't mean your money is fully protected. If a major banking crisis occurs, it could take weeks or even months for people to recover their funds. That's why financial experts always recommend keeping some emergency cash outside of the bank and diversifying where you store your money. The key takeaway: your deposits aren't just sitting in the bank and they're not as secure as you might think. While banks want you to trust them with your savings, they are primarily focused on making profits. Understanding how fractional reserve banking works can help you make smarter financial decisions and avoid unnecessary risks. Number 6, credit scores are designed to keep you in debt. Your credit score is one of the most important numbers in your financial life. It determines whether you qualify for loans, credit cards, and even things like renting an apartment or getting a lower insurance rate. But what banks don't tell you is that this system is not designed to reward financial independence. It's designed to keep you borrowing. In fact, if you avoid debt altogether, your credit score won't grow, making it harder to access financial opportunities in the future. Think about this. The easiest way to improve your credit score is to take on debt and pay it off slowly. If you take out a credit card, make purchases, and pay off only part of the balance each month, your score goes up. But if you simply save money, avoid debt, and never borrow, your credit score stays low, even if you're financially responsible. This is because the system prioritizes those who prove they can manage debt rather than those who avoid it altogether. Banks and credit bureaus reward people who keep using credit, but not necessarily those who are debt-free. For example, someone with a long history of using credit cards and making payments, even with debt, will usually have a higher credit score than someone who has never taken out a loan. This is why many people feel pressured to keep borrowing just to maintain their score, even when they don't actually need credit. This creates a dangerous cycle where people chase a high credit score instead of building real wealth. They may take out unnecessary loans, keep multiple credit cards, or carry a balance just to keep their score from dropping. But in reality, the smartest financial move is to focus on assets that grow your wealth, like investments, savings, and real estate, rather than playing the credit score game. The takeaway: a good credit score is useful, but it shouldn't be your main financial goal. Instead of trying to hack the system by staying in debt, focus on achieving financial independence. Having money in your account is always more valuable than having a perfect credit score. Number 7, banks don't teach you financial education for a reason. Have you ever wondered why schools don't teach you how to manage money, invest, or avoid debt? Schools cover history, science, and literature, but almost never personal finance, and that's not a coincidence. The less you know about money, the easier it is for banks to profit off you. If financial education was a priority, people would be smarter with their money, and banks would lose billions. Think about it. If schools taught students how interest rates, debt cycles, and inflation work, fewer people would rely on credit cards and loans. If young adults understood how to build wealth through investments, they wouldn't park all their money in low-interest savings accounts. But banks thrive on financial ignorance. The more people rely on credit, the more money banks make from interest, late fees, and hidden charges. This is why self-education is the key to financial freedom. The wealthiest people don't depend on banks for guidance. They read books, take courses, and seek mentors to learn how to invest in stocks, real estate, and businesses. They understand how to use money as a tool rather than falling into the traps banks set for the average person. Banks want you to follow traditional advice, work hard, save money, and take out loans when needed. But this advice keeps you in the system while banks use your money to make even more. They won't teach you how to leverage assets, protect your wealth from inflation, or create passive income, because that knowledge gives you control, not them. If you want true financial independence, you have to take control of your own financial education. Learn how to grow your money beyond a savings account. Understand how debt works so you don't get trapped in it. And most importantly, don't rely on banks to guide your financial decisions. They only give advice that benefits them. The harsh truth is, banks don't want you to be rich. They want you to be dependent. But once you learn how money truly works, you'll never see the financial system the same way again. Now that you know these 7 truths about money, what will you do differently? Banks rely on keeping you uninformed so they can continue profiting off your debt, your savings, and your loyalty. But now that you know the truth, you have the power to take control of your finances. So, what's the most surprising thing you learned today? Let me know in the comments. And if you found this video valuable, don't forget to like and subscribe for more content on financial freedom. See you in the next one.